Hello, this is Cordell with smallapartmentinvestors.com. In this presentation, I'm going to talk about 7 pillars of 1031 tax exchange. So you may be saying, what in the world is 1031? Well, it's actually an IRS code that allows a person to avoid paying capital gains tax when they sell a property. And so from the proceeds, what they'll do, they'll just reinvest that into another property. But there's certain rules that need to be followed. And on the website, smallapartmentinvestors.com, I have more information on there you can check out. So let's get into it. First one, be like kind. So what that means is that it cannot be a personal home. It cannot also be someone that flips houses because their intent is to resell as quick as possible. They're not holding the property as an investment. It has to start off and end the same way. The intent, that is, of how the property was purchased in the beginning. So it can't be an apartment building with a personal residence. It has to be an investment vehicle that's for investment purposes. 2, 45-day calendar days of identification period after closing. No exceptions, no extensions. So what happens is there's a list of properties that must be given and attached with specific addresses. It has to be up to 3 properties to be identified. And if you want more than 3, what the IRS will do, they will put some limits on you. So for example, the total value of all the properties have to be less than double than what the property is that you sold for. So this rule of 200% rule is what they call it, is if an investor exceeds the 200% limit, the exchange cannot happen. And that is why the easiest and most common method is for a lot of people just to pick 3 investments. They don't typically go over that threshold. 3, 180-day purchase period. Purchase and closing by the 180th day of closing the property. The property must be on the initial list. Remember earlier I talked about those 3 different lists to buy. So after the 45 days of identifying the properties, you will have 135 days remaining to meet the 100-day limit. 180-day limit, that is. Use a qualified intermediary, also known as a QI. So this person's like a bridge between you and an escrow company. You as a seller cannot touch the money. You cannot have prior relationships as well with the QI. So what the QI will do, they have forms that they fill out on your behalf. 5, title must be in the same name when doing a 1031 exchange. What name is on the property when it's being sold has to be the same name on the property that's being purchased. It could be a person's full name. It could be in a trust. It could say 123 Main Street LLC, for example. Whatever it is, it has to stay the same. Now, sometimes to get around this, some people will do a quit claim deed and then to the name of what the new property will be. So if it is a LLC currently, the LLC must be liquidated and the deed be given to the partners with the tenants in common interests. 6, reinvest equal or greater amount. The new property has to be equal or greater of what was sold. All cash profits will need to be reinvested. You can deduct closing expenses and commissions from the sale also. Any money that you take out from the transaction is called boots, and that money that you take out will be taxed. when you die, your heir won't have to pay capital gain tax on the property. So let's say that you do a 1031, you get another property, and you're sitting there for 20 years, and then you pass away, like it says right here, number 7. Your kin is going to pick it up and don't have to worry about capital gains tax. So this is just a little nutshell of 1031. I have some more information to dig deeper. So check out the website, small apartment investors.com. Thank you.